why you should invest your money. What's up and welcome to Creative Money, the show that helps you make money in creative ways. Today we're covering investing basics to help you get a better understanding on why you should be putting your money in the stock market and not just letting it sit in a bank account gaining 0% interest or spending it all. Because I know it's fun. I was just in Vegas, I get it. Gonna give you a little pro tip at the end, so stick around for that. Inflation is bad, okay? And we're experiencing record highs right now here in the United States and around the world. So if you're not entirely sure what that means, basically, let's say you had $1,000 today. Now let's look exactly 1 year from now. That $1,000 going off the current inflation rate will only be worth about $920. Now it'll still say $1,000, but you'll only be able to get about $920 worth of today's value tomorrow. So that's why inflation is bad. So if your money is just sitting in a bank account making 0 or 0.01% interest, you are just bleeding money thanks to big scary inflation, and that sucks. I'm gonna show you some different assets you can put your money in to hopefully make some money and not lose it all to inflation. I'm purely here to give you insight in the basics and wrap your head around what the world of investing is, because it's not all stock markets, but that is primarily what we are going to be talking about today. Let's take a look at what some of those assets are. Some of the assets you can invest in, and this is not an exhaustive list, are stocks, bonds, mutual funds, property, you got crypto, although and also commodities, which is like the raw materials of the earth. We won't be covering all of them in this video, but the main three of stocks, bonds, and mutual funds. Maybe I'll cover the other ones in another video, but this will be enough for today. Now, the safest option of this list is bonds, typically government bonds, where you will loan an amount of money for a set amount of time to the government and they will pay you interest payments over time. Now, it's not a lot. It's typically 1.5 to maybe 3%. But right now, when it's recession, everything's kind of up, they are paying out slightly better. So they're not volatile. It's very secure because the government's not going to let itself fall on its own debt, even though we are $300 trillion in debt in the United States. Like, what is that number? Like, what?
Hey, Editor Denver here. So that number is actually 30 trillion, not 300 trillion. Sorry about that, misremembered. However, what the
The point is, if you can't beat them, join them. So here we are. Capitalism! Next, mutual funds. And I talked about this in my first video where I talked about ETFs, which are exchange traded funds. For the sake of this video, they're the same. There are slightly poignant differences, but like for the sake of this video, they're the same. A fund that has a bunch of companies, not just one, and it has a lot of shares of all those companies all in this pool, and you invest in that pool, and therefore you own a little bit of all those companies, and you generally see better returns than if you were to just throw money across the board at a bunch of companies, because they all kind of negate themselves in this fund. Now, on the flip of that, when stocks are down, we're seeing the tech bubble burst, we're seeing all these types of things. Mutual funds, while not immune to that, often see less of a fall, because there are going to be some companies inevitably in that fund that outperform the market. You don't know, I don't know which companies those are going to be now, 5-10 years from now, but if they're all in a mutual fund, very high chance you will have a little bit of money in that company when it's good payday, all right? So mutual funds are just a swimming pool of a bunch of companies, so you mitigate your risks across all these companies instead of just one company. Now, I'm not necessarily recommending these, but more as a starting point, here are some mutual funds and ETFs that you can look up and do some more research on. Treat this as a starting point to go do more research. Cool. And the last one for the sake of this video and the slightly more riskier but higher reward is stocks directly. Now, I just spoke about mutual funds, how they will kind of even things out over time, right? However, when you own stocks, if it's a company you truly like and believe in and you've done the research and you really, really think there is future growth potential, maybe they have a nice dividend, that is what you can invest in. But basically you own one share of the company that you bought it for, and you go on. You can buy a lot of shares, you can buy a little amount of shares. Obviously, the more money you have, the more you can buy, and therefore the more you can make. or the more you can lose. So it does kind of go both ways. So always do some research and really know and study. And that's why personally, until you kind of get your feet wet in all this space, I highly recommend mutual funds because someone else is managing it for you, and typically line goes up with that. With stocks, it's kind of all over the place. And I've made money, but I've also lost money doing individual stocks. But 65% of my portfolio is mutual funds and 1/3 of it in various stocks or other assets. But now that you've seen this video and understand a little bit more of the risk and the upsides of all these different types of investments, you can make a more thought out and strategic plan for your financial future to start making some extra money. And now for the pro tip, invest in funds or stocks that pay dividends. Not all dividends are created equally. Not all of them are worth the same amount. However, what a dividend is the fund or the company paying you, the shareholder, a little bit of their profit, depending on how many shares you own. This can be 8 cents. This can be $1.30. This can be a couple dollars per share. So again, if it's a couple dollars per share and you own 100 shares of something, you now just got a couple $100 just for owning a thing. Hell yeah. So what you can also do with those dividends is have them automatically reinvest. So instead of going to your brokerage account or your bank account, they can go directly back into the asset, whether it's the fund or the stock that you own, buying just a little bit more of that asset. And now that compounds because that little bit extra of the extra share that you own is also going to get a dividend, and that'll compound, and that'll compound, and that'll compound, and that. Going back to the list we had before, if we look at SPY, they pay dividends. This is their rate. And so even though the price of a share is high, around $400 at the time of this video, that is a lot. You can buy partial shares on a lot of tools, much like Robinhood, and you still make dividends whether you own a full share, a few shares, or part of a share. You still make dividends. Obviously, it's going to scale accordingly, but you can still make money with your money purely for owning an asset. So I know that was a lot, but hopefully now you have some basic understanding of investing, the different types of assets that are out there, the pros and cons to all of them. Again, this is not an exhaustive video. Now we can move on to the next step, and that is making some money. Remember, if you got money problems and nothing changes, nothing will change. Invest in yourself, invest in your wealth, invest in your health. Let's go make some fucking money. Have a good one.